Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in and it appears we finally are starting to see the housing market flip back into the direction where we want it to if you're on the sideline, which is continuation of price corrections. So it's starting to look like the rally, the so-called rally right now, is starting to finally lose some steam. And let's not forget where this rally came from, because remember, in June of last year, we had price decline. So what has changed right now? What I believe has changed is the sentiment of the consumer. I think one of the predominant reasons why consumers are purchasing right now is basically the banking bailout. When the Federal Reserve injected hundreds of billions of dollars in liquidity into the banking sector, it postponed credit tightening. It postponed unemployment. It postponed additional corrections in values. And remember this as well. In 2006, we had 5 months of decline, followed by 6 months of increase before a total collapse. Right now, we have 3 months of increase. And we had, I believe, 6 months of decline that superseded the decline in 2006. So, in other words, I think it's going to be worth it to consider those things. And that's not emotion, y'all. This is data. These are facts. But regardless, we're going to go over Redfin's weekly housing market update to see the trajectory of week over week trends. And before I go into all of the graphs, first I'm going to read a little bit of the article to see what Redfin's opinions are and what they're saying to people. And after that, leading indicators and then the charts. But you guys, please remember, I'm not a financial advisor, even though my bio is as a realtor, loan officer, and instructor in Texas. Like this video for staying ahead of the trends. Subscribe if you haven't already. Shoot me a comment below. Do not leave this video until you shoot me a comment below. I thank each and every one of you. Now, let's get started. So the name of their weekly housing market update this week is hysterical because it's delusional. But here's what it is. Housing market update. Fewer metro areas are seeing home price declines as lack of inventory keeps prices afloat. U.S. home prices are down 2.7%. And even though it's saying that they're down, they're actually going up. But again, the question is are we finally seeing that stop? Prices are dropping in fewer metros. That's because there's little inventory hitting the market, with homeowners handcuffed to their houses by low rates. I think a better thing to say there is, they're not willing to cash out yet. I don't think people are handcuffed. On a local level, home prices are declining in 28 of the 50 most populous U.S. metro areas, down from a high of 32 metros at the end of April. So what this is saying is there's still 56% of the largest populous U.S. metro areas still experiencing year-over-year price decline. So it's still 56%. It's down from 32. It's now 28. That's a difference of 8%. I think they could have titled this article differently, because again, more than half of the metro areas are still experiencing year-over-year price decline. That's a reflection of the mismatch between demand and supply propping up prices. Pending home sales are down 15% from a year earlier, but that's much smaller than the 24% decline in new listings. Today's elevated mortgage rates continue to discourage homeowners from selling. Nearly all of them have a mortgage rate below 6%, unless you're a new buyer. While this week's average 30-year rate was 6.39, and honestly, guys, the average right now is 6.9. That has actually shot up this last week. The lack of new listings has drained inventory, with the total number of homes for sale dropping over the past 2 months, going against typical seasonal trends. And here's the thing, they say that, yet months of supply went up. This week, we had week over week increase in months of supply. The share of homes selling that are doing so within 2 weeks also bucked seasonal trends, illustrating urgency from buyers who don't have much to choose from. That share has steadily increased over the past 2 months, while it typically falls this time of year. That desperation is very, very costly. It is very, very dangerous. High mortgage rates continue to dictate the housing market. Although a lot of home buyers have got used to rates in the 6%, many are finding ways to lower their monthly payments, like using a 2-1 buy down, which is a temporary buy down predominant in new construction. It brings their payment lower for a year to 2 years, and then it goes back to normal. It's hard to imagine a flood of new listings until rates come down at least into the 5s. For those who are selling now, the silver lining of giving up a low rate is that Hardly anyone else is doing the same thing. That means buyers who are hungry for new listings will bite, and they don't have much power to negotiate the price down. Just another reason to wait. In my opinion, and that's what I'm doing, just another reason to wait. Newly built homes could help relieve the inventory shortage even if rates remain elevated. And there are signs more may be coming. U.S. home builder confidence rose for the fifth straight month in May, hitting its highest level in nearly a year, and permits for single-family homes rose to a 7-month high in April. And that is really, really surprising to me. Let's continue. Housing market trends are playing out differently in different parts of the country, and we know that. But agents in most metros are reporting that demand is outpacing supply. Boise, which had one of the hottest markets in the country during the pandemic, Redfin Premier Agent says today's buyers are having a hard time finding homes because homeowners are sitting on the 3% mortgage rates. I'm practically begging potential sellers to list, especially those who are in more affordable areas with more affordable price points. To me, that's just more cheerleading. I don't see caution there. I see buyers are rushing out, and you should rush too. That's how I read that. Now, leading indicators of home buying activity. Now, daily average here, it says 6.82%, but right now it's 6.9. That's as of Thursday with 6.82. As of Friday, 6.9. Mortgage applications decreased week over week 5%, still down 26% year over year. Buyer demand is down 2% week over week. Google searches are down 16% from a year earlier. Touring activity was up 20% from the start of the year compared to an 8% increase at the same time last year. Now take a look here. This is what I don't like. The median sales price was $371,875, down 2.7% from a year earlier. So even though it says down, the median sales price has actually been going up. It's only saying it's down 2.7% because it's comparing to what the median sales price was this exact time last year. And the comparison of those two things is a decrease of 2.7%. But nevertheless, what we're seeing is that median home sales price of 371 pretty much go up every single week. So we're hoping, you guys, that trend starts going down. Now, home prices decline in 28 metro areas, obviously, with Austin number one. Austin's leading the way, followed by Oakland, San Fran, and Las Vegas also makes the list, and then obviously San Jose. So a lot of this is happening in California. Let's visualize some of this data and go over the week over week charts just to see what we can see as far as the trajectory of the trends. So let's start here at median sales price. Now, again, as we can see here, it's stating that it is down 2.7% year over year. That's good. But this is my point. Ever since about right here, you guys, even though it's saying it's down, the trajectory is still going up. Okay, but they're measuring right here. They're measuring the gap right here. So the gap right here is 2.7%. Now remember what I believe is going to happen. So I believe about right here at the end of June, that's when I think we're going to have that whiplash downward. And I don't think it's going to be gradual. I'm saying whiplash because none of this is making sense. And when the cat's out of the bag, that's when the fear and the panic start. I think it happens then. Do I know it's going to happen then? No, but this is what I'm thinking. But nevertheless, week over week, median sales price has gone up, and it has been trending that way since middle to end of February, which I find also interesting. That's when the banks also got bailed out and tax returns. Now, here is some good news. This is the Johnny chart. This is median asking price. Now, you can see that median asking price is under last year. Do y'all see that? Not by much, but at least that trend. See that week over week trend right there? That's a week over week trend. At least it's went downward. Listen, guys, if it goes up again next week, when we get our next week data, if it goes over this red line, okay, if it goes over this red line right here, that means that the median asking price is exceeding the median asking price pace of last year, which to me is psycho. That's crazy to me. So keep your eye on that, but at least week over week, it went down. So median asking price, remember you guys, it leads median sales price. So what's leading median sales price is actually going down week over week. That's great news. Take a look at this, you guys. Next week, when this data comes out, we're going to see this go up like sharply, like this direction. Next week, because they're only using, and this is crazy if you think about it, they're only using 6.39%. Right now it's 6.9%. So that payment is going to be a new historical high mortgage. We have historical high mortgage payments right now. Why is that? Because they need to curb demand. Really shocking if you consider about 2 years ago, mortgage payments were all the way down here, under $1,700. all the way down there. Next week, we're probably going to see this number right here skyrocket up. Not a little bit, but skyrocket up because the interest rates are over half a point higher in just a few days. And that's probably because they're starting to understand that inflation is actually super sticky and the inflation battle they're losing. Inflation is starting to resurge, which again, I've been telling you guys, if that happens, we're going to get a second round of beatings and that's not going to be good for anyone. Unless you're on the sideline like myself and you can take the first hit, right? And the first hit being recession, job loss. Now look at this, you guys. This should be way worse than it is, but it's not. Pending sales are only down 15%. I mean, it's kind of heartbreaking. You know, it should be down way more than that. So I'm hoping it's just going to start to decline like this. I'm hoping that's what's going to see, guys. Probably it's going to happen. And again, this usually starts happening right here, end of June. So we're almost there. I think it's really going to be out of the bag here in about 5 to 6 weeks. And remember, you guys, I got the year-over-year price decline right when I said at the end of February. Remember that. Same thing's going to happen right now with these trends reversing drastically again towards the end of June. All right, so new listings are down 24% year over year. So we're way down here. You know, that's no surprise. And honestly, with all of this talk about interest rates being so low, if people were trapped in their houses, that should actually be much lower. So the fact that it's only 24%, very interesting. Now, this is a little bit of a new thing here. Now, usually I look at Fred economic data to go over active units, not pending units. And you can see we're up 2% year over year. So we have more inventory right now than we did last year, but not a lot. Okay. The name of the game, y'all, is inventory. We need more inventory if we're going to have a housing market that's balanced, that can be sustained. We need more inventory. Where's the inventory going to come for selling? Maybe those 3D printed houses, maybe those pop-up houses. But one thing that is for sure, we will need more inventory, and we're already seeing some of the forced selling. Not a lot of the forced selling, but some. Here is the good news. Finally, we have an increase in months of supply. Finally, you guys, it was like from middle of February to right now, we had all of this decline in months of supply. Look at this. We started over 4 months of supply at the start of the year. Look at, and it went straight down, kind of plateaued here. And finally, week over week, we are going up. Finally, I've been watching this like crazy. Now it's only up, I believe, 0.2 months. I think last week it was at 2.5 or 2.6, but thank God we're starting to see that flip. And it will probably continue to flip, especially if interest rates just went up another half a point. This is something that I think is going to go up just like mortgage payments. And hopefully we'll also see this trend reverse as well. This is how many homes sold for above list price, 33%. 33% of homes. So 1 out of 3 homes are selling above listing price. That's not good. That is not good at all. But week over week, that's up. Hopefully that will go down. Obviously, we want that to go down. We don't want to pay high prices for houses, but let's look at this next trend now. This is one of the leading indicators to understand whether or not interest rates are playing a role in the housing market. So we can see listings with price drops still super high at 5.1%. Week over week, that did go up slightly week over week. So that is good. Hopefully that will continue to go up. But that trend is going the trajectory that we want. Also, more good news. Another trend that we're seeing like better is the demand. So at least it still needs to go lower, but at least week over week, we can see week over week right here, it trended downward. So again, it did trend downward week over week. And you guys ask yourself, now that interest rates are a half a point higher, do you think this is going to go up? Or do you think it's going to go down? So in conclusion, I think it's a really, really good thing that the past week that interest rates have been skyrocketing, because that's exactly what we need right now to curb demand in the housing market. And I'll make the argument, if interest rates would have just stayed at 7%, and if the Federal Reserve would not have bailed out the bank, I can almost assure everyone that the housing market correction, crash or reset would have just continued, because the power of human and consumer emotion. And that's why I'm always preaching to you guys, work on your mindset, have a better understanding in your local housing market. Having a better understanding about how things work generally gives us more confidence when making decisions about our future. So in other words, empowerment, empowerment, empowerment. And don't forget this, love. Love your family, love your life, improve yourself, and don't just get lazy on the sideline. If you're even on the sideline, maybe you're not, but if you are, three things: credit, income, assets. Increase those things, and by doing so, generally we increase our purchasing power, which is what we should be doing right now, because when a recession hits, when unemployment hits, the odds are we're all going to get impacted from that process. But the difference will be how we make it through that process, which is why I keep preaching to you guys: prepare for the first hit. If you can get through the first hit of recession, odds are we're going to be way better off once it's time to buy. At least these are all my opinions, you guys, and I'm trying to do the best I can. So again, you guys, do me a favor, show some love, like the video. And other than that, I really hope you guys got some new value, insights, and perspective in today's video. And if you're out there investing in real estate, you know I wish you luck, and I hope you win.